Good morning. Welcome to this public lecture jointly organized by the Kuan Yew School of Public Policy and the Monetary Authority of Singapore. Today we're very fortunate to have the Deputy Managing Director of the International Monetary Fund, Mr. Shinohara, who's going to be talking to the theme, Leading the Global Economy, the Outlook and Policy Challenges Facing Asia. Now, I'm sure several of you will have already been familiar with Mr. Shinohara. Let me just give you a little bit of quick background before we get started. Mr. Shinohara took over the position of Deputy Managing Director at the IMF in March this year. Prior to that, he had a long and distinguished career in the Japanese government, including, most notably, positions as Director General of the International Bureau and Vice Minister of Finance for International Affairs. And in that latter capacity, he has, over the years, participated in many of the regional meetings and in the G7, G8, G20, ASEAN plus X, etc. Prior to his professional career in the Japanese government, he obtained his BA degree from Tokyo University and a Master in Public Affairs from the Woodrow Wilson School, Princeton. And he was an associate at the Center for International Affairs at Harvard University. Well, thank you very much. As I mentioned, the theme is the outlook and policy challenges for Asia. And Mr. Shinohara has indicated he'll speak for perhaps 30 to 40 minutes, following which we'll open the floor to a Q&A session. So thank you very much.
Thank you, Charles. Good morning, ladies and gentlemen. It is really my great honor for me to be here today. And I'd like to extend my gratitude to our hosts, the Kuan Yew School and the Monetary Authority of Singapore, for inviting me to give this address. As we all know, we are in challenging times, but challenges bring opportunities as well. And so it is crucial to borrow some words from Minister Mentor Lee Kuan Yew to have decision makers who have got foresight, good minds, who are open to ideas, who can seize opportunities. After nearly 2 years of global economic and financial upheaval, the worst in 60 years, shockwaves are still being felt, as we have seen with recent events in Europe and the resulting financial market volatility. Three messages are clear from our experience. First, no country or region stands alone in today's global economy. This is true for Asia, even though it weathered the storm much better than most. Second, the policies and institutions of yesterday will not continue to be effective in tomorrow's world. They must evolve with the global economy. Third, there is enormous benefit from, and indeed durable, global growth depends on a collaborative policy effort across countries and regions. The lessons learned from the crisis need to be used to forge a better balanced and more inclusive global economy in the future. Asia is positioned well to set a standard for economic performance, policies, and collaboration in the years ahead, and to ensure this is achieved. Now, in my address today, I will discuss the economic outlook, particularly here in Asia, and some of the policy challenges we face in building the foundations for a more robust and stable economic and financial framework. As I see it, the policy challenges are twofold. First, what policy actions are needed to support the global recovery and achieve a more sustainable and balanced growth path? Second, how might we strengthen the international monetary system to reduce the risk of a crisis, such as we have just seen happening again? So now, let me turn to the issue of economic outlook. This chart is based on our so-called World Economic Outlook issued by the IMF in April this year. The global recovery is proceeding in large part as we have expected. What we are seeing is a multi-speed recovery. Growth is uneven, and even growth is uneven across and even within the regions. And recent developments in Europe and the associated financial market volatility have reminded us that the recovery is fragile and still subject to considerable risks. And we are not yet out of the woods. Most advanced economies are experiencing a subdued recovery, given the size of the decline in activities that preceded it. The United States is off to a better start than Europe, where concerns about fiscal vulnerabilities in a number of countries have come to the fore. In Japan, a strong rebound in trade is helping the modest recovery. The outlook is much brighter for many emerging and developing countries, and Asia is clearly leading the way. Growth in Asia has rebounded swiftly, and output in most of Asia, including here in Singapore, is now well above its pre-crisis levels. In Singapore, growth in 2010 is projected to reach 9.9% compared to minus 1.3% in 2009. Other sub-regions in Asia, such as the ASEAN 5 countries, are expected to post a strong rebound of about 5.5% in both 2010 and 2011. For the first time, Asia's contribution to a global recovery is outstripping that of other regions, but the recovery marks a sea change in two other important respects. First, rather than being dependent on a narrow export-driven recovery, domestic demand, particularly household consumption, are reinforcing Asian growth. As you can see at the chart on the left side, compared to the period during the Asian financial crisis, the current episode is shown in the red line there. And second, instead of the slow return of capital inflows we have seen in the past, there has been a surge in capital inflow. The right-hand side chart shows the changes of the capital flows into this region, and compared to the Asian crisis period in the late 1990s, the surge in inflow of capital into this region is quite robust just after the crisis. I will come back to the capital flows issue later on. So this is a testament to Asia's resilient regional economy and the improvements in the economic framework that have been put in place over the past decade. Asia will continue leading the global economy forward, buoyed by strong recoveries in China, India, and other countries. Asia is expected to grow by 7% this year, and next, although the pace of recovery will vary across the region. But as I noted earlier, the global outlook remains unusually uncertain, and clearly downside risks have risen significantly. As we all know, chief among these risks are fiscal vulnerabilities in many advanced economies. A key concern is that the room for continued policy support has become much more limited and has in some cases been exhausted. This chart shows, the familiar numbers that talks about the very high public debt of the advanced economies and required adjustments in primary balance in each of those countries in order to bring the deficit ratio down to 60% in 2030. And also the developments in financial markets pose major downside risks to the global economy. They could have negative effects on private and sovereign funding rates, bank balance sheets and credit conditions, and capital flows, portfolio allocations. The ability of banking sectors to withstand funding shocks is of particular concern. This risk is heightened by market doubts about political effectiveness and the ability of governments to deliver on needed policy measures, especially in Europe. Beyond these global risks and the risk of heightened aversion to risky assets that affect stock and bond markets globally, there are two issues of particular interest for Asia. One is the potential spillovers from Asia euro area crisis. Adverse developments in Europe could disrupt global trade with implications for Asia, given the still important role of external demand in this area. If you look at the chart on the left-hand side, it shows the dependence on external demand as a percentage of GDP in each of the countries in the region, which is in many of the countries in this region, the dependency ratio is higher than the OECD average. Also, Asian exports are concentrated in highly cyclical medium and high-tech goods. So that is another vulnerability that we need to take into account. Also, the right-hand side chart shows that export exposure to Europe is almost as large as that to the United States. So this is the potential the risks that this region has at this moment. And as for the financial system contagion, Asia's direct financial linkages to euro area economies are limited, although a major credit event could result in a significant spillover through funding channels, especially where banks are dependent on wholesale funding. Second issue that is of particular interest for Asia is that there is increased uncertainty and potential for volatility in the outlook for capital flows. Should the recovery continue as expected, Asia's bright growth prospects, together with low interest rates in major economies, would likely attract more capital, and this could lead to risks of overheating in some economies if appropriate policy action is not taken. On the other hand, further increases in global risk aversion could see capital flows change direction quickly. As we can see in this chart, what happened in recent weeks shows that capital flows can change directions quite quickly, and it could be very volatile. Nonetheless, while Asia is not immune from developments elsewhere in the world, the region is in a very strong position to tackle these risks should they be realized. The key will be for policymakers to keep an eye on the bigger picture and be ready to act swiftly as developments unfold. With Asia's economic muscle growing, the policy choices made in this region will have an important impact on the global economy. So, what actions should policymakers take to mitigate these risks, to reduce our susceptibility to crisis, and to secure sustainable post-recovery growth? I'd like to focus on three policy priorities: the pace of unwinding macroeconomic stimulus, financial sector reforms, and managing volatile capital flows. First among them is judging the appropriate pace for unwinding macroeconomic stimulus and financial sector support put in place during the crisis. Here, there is a difficult balance to strike. Reassuring markets is critical to preserve the recovery. Too little action to reduce sovereign vulnerabilities could result in continued financial market volatility, and that would adversely affect growth. However, tightening fiscal policy too much or too quickly could have the same effect. The right balance will depend on country circumstances. Most advanced economies, particularly those facing sluggish growth and that still have some fiscal space, do not need to tighten this year. Nor should they add further to the stimulus. And starting next year, strong action will be needed to reduce sovereign vulnerabilities and preserve fiscal credibility. Well-designed, credible fiscal consolidation strategies that strengthen long-term fiscal trends are needed. And these commitments should be made now to reduce the risk of adverse market sentiment that compels more aggressive consolidation. Countries with more precarious public finances and rising risks premier need to begin consolidations without delay. The recent volatility in financial markets, in particular in Europe, reminds us that the global economy is still very fragile, and there is a risk that sovereign debt programs being experienced could spill over to other areas. We are already seeing a number of European countries that are under pressure from financial markets taking important consolidation steps, and these steps are very welcome. But it will be critical that as countries pursue prudent fiscal policies in the face of the sovereign debt crisis, care be taken to strike a balance with the growth-promoting policies. History has shown us that strong growth is vital to fiscal adjustment. Without growth, debt problems are much more difficult to solve. Reforms that help boost potential growth, reform of goods, labor, and financial markets will therefore be crucial. With the faster pace of recovery here in Asia, macroeconomic policies have already begun to normalize, yet even within Asia, the right pace of exit will vary. In this slide, on the left-hand side, we show the fiscal impulse, that is the change in fiscal policy stance of each country compared to the previous year. And right-hand side chart shows, this is a kind of an indicative chart to show the stance of monetary tightening in each of these countries. Fortunately, the strong position of most Asian economies provides the space to respond flexibly. In the event of spillovers from Europe, there is ample room in most Asian economies to post the withdrawal of fiscal stimulus. For Asia, the balance of withdrawing monetary and fiscal stimulus will need to be weighed carefully as the recovery evolves. It will depend on the speed at which output gaps are closing and the potential for inflationary pressures. The strength of capital inflows will also be a factor. Indeed, in this respect, Singapore is a leading example of how macroeconomic policy management has transitioned smoothly out of crisis mode. Here, exceptional policy support, fiscal, monetary, and financial, has already been rolled back as Singapore's economy rebounded strongly from the global recession. Both monetary and fiscal policies have returned to a largely neutral stance, and plans to remove crisis-related support in the financial sector, such as the blanket deposit guarantee, are on track. Another part of the story is the need to rebalance global demand to secure sustained high global growth. The common challenge for many Asian economies will be to nurture private domestic demand as an engine of growth. Here too, financial sector reform and growth-enhancing structural policies will help, as will a more flexible exchange rate. This brings me to the second policy priority, financial sector reforms. Financial sector reforms are needed for financial sector reforms are needed for lasting financial stability, but I fully appreciate that policymakers have a difficult balance to strike between promoting the safety of the financial system while also keeping it innovative and efficient. Before the crisis, regulation was inadequate, but so too was supervision. There is broad agreement on the key principles for reform, widening the regulatory perimeter to include all systematically important institutions, improving the measurement and regulation of systemic risks, bolstering supervision, and strengthening crisis resolution mechanisms. Financial systems in Asia has proved very resilient during the current crisis. This owes much to the extensive financial reforms following the Asian crisis of the 1990s, as well as the role of traditional virtues, maintaining adequate capital, avoiding excessive reliance on short-term funding, ensuring proper loan underwriting, and following sound risk management. However, Asia's banking systems must continue to work to stay ahead of the curve. Indeed, banks and regulators in Asia have already grasped the benefits of introducing some of the proposals being discussed globally. For example, Korean banks are now required to gradually raise their long-term foreign currency borrowing to 100% of their long-term lending from the previous 80%. These financial sector reforms will also help in tackling the third policy priority, that is to manage the volatile capital flows. Should Asia continue to attract significant capital inflows, the challenge will be to ensure that these resources are absorbed effectively and without excessive run-ups in asset prices. On the other hand, if there were to be a sustained reversal of capital flows as a result of developments elsewhere in the world, policymakers will need to consider a number of policy options to ensure that there are no dislocations in financial markets. Policymakers have a range of tools at their disposal, in addition to conventional macroeconomic policy instruments to deal with the effects of capital flows. Macroprudential measures can help safeguard financial stability and shield the real economy from disturbances stemming from volatile capital flows. We have already seen some countries in Asia put in place prudential measures to slow the run-up in asset prices as flows surged over the past year, as you can see on the left-hand side of this slide. Most countries in Asia also have room to address the impact of capital flows through more flexibility in exchange rate mechanisms. In some exceptional circumstances, controls on capital flows may be useful and can provide temporary breathing space during periods of large swings in capital flows. A common theme across these policy challenges is that a collaborative approach is needed at both the regional and global level. In today's world, policies in one country often have far-reaching effects on others. It is particularly true with the need for many advanced economies to consolidate their fiscal positions in the coming years. Offsetting demand will need to come from elsewhere in the global economy, including Asia, where meeting the growing need for modern infrastructure and others is a clear policy priority. Another example is regulatory reform. Regulatory changes need to move in step to ensure that a consistent set of policies are in place and to reduce the opportunity for financial systems to exploit differences in national regulatory regimes. In this environment, IMF must do a better job of highlighting the spillovers that one country's policies have on others, and to point out risks as they emerge in a clearer and more forceful way. We are trying to respond to this challenge. We are sharpening the tools we use for multilateral surveillance and assessing vulnerabilities. For example, cross-border linkages and potential for spillovers are increasingly the focus of our flagship publications, the World Economic Outlook and the Global Financial Stability Report, and also in our regional economic outlooks. The early warning exercises that we undertake jointly with the Financial Stability Board aims to identify vulnerabilities and the impact of tail events on the global economy. With Asia's economic power set to rise further, policymakers in this region have an important opportunity to lead in this collaborative policy approach. Even as domestic demand plays a growing role in Asian economies, the region will increasingly become integrated in the global economy. But integration raises the potential for spillovers, both positive and negative. Singapore is a good example of the benefits that openness can bring. To take advantage of these potential benefits and minimize the potential for negative spillovers, a multilateral approach to policymakers will be essential for Asia too. The world needs Asian leadership to sustain global growth and to develop policy mechanisms to contend with the new global realities. Now, let me turn to a little bit different subject, that is the reform of the international monetary system. The recent crisis had its epicenter in the U.S. Financial system, as is described as the subprime crisis, but it has quickly become a truly global crisis, highlighting the number of imperfections in the international monetary system. First among these was the global economic imbalances that built up for many years before the crisis. Without an automatic or smooth adjustment mechanism, these balances were prone to disruptive corrections. At the same time, volatility in capital flows created uncertainty about the availability of liquidity, and we witnessed a flight to safety during the crisis. And given the heavy reliance on a handful of reserve assets, these shocks were transmitted rapidly from the core to the rest of the world. These imperfections also partly explain the rapid build-up of foreign exchange reserves across many emerging market countries. Foreign reserves have been accumulated for precautionary or self-insurance reasons, and also for non-precautionary reasons. there has been a threefold increase in reserves compared to 10 years ago. And for most emerging markets, reserves reached nearly 5 times short-term external debt before the crisis, well in excess of traditional norms. This chart shows the rapid increase in foreign reserves as a percentage of imports, and the right-hand side shows the level of reserves as a percentage of short-term debt. And it is also true that the reserves are concentrated in just a handful of countries, most of which are in Asia. Addressing the issues that affect the demand side and supply side for reserves will help in the reform of the international monetary system. Here I will mention a few options that we can think of. The first is to improve the financial safety net. Here I believe that IMF has a role to play, and there are a number of options that we can examine. IMF could provide strong insurance facilities. Last year, as many of you already know, IMF made a major reform of its lending instruments by introducing the so-called flexible credit line. But further refinements would help, for example, by extending the duration of the flexible credit line, increasing the predictability of qualification of countries, and removing the informal cap on the amount of access. Separately, the IMF could also establish a more attractive precautionary credit line for countries with good policies that may not qualify for a flexible credit line. Stronger synergies between the IMF and the regional financial arrangements would further strengthen the global financial safety net. The benefits of regional arrangements are well known here in Asia, and here I welcome the multilateralization of the Chiang Mai initiative that has become effective last March, which further enhances this important regional initiative. This is indeed a positive development for the region, but the IMF could also play a role to support these kinds of regional arrangements. In the coming period, IMF staff will consult with members of the regional arrangements, such as the Chiang Mai Initiative and others globally, to explore the scope for greater collaboration with the regional arrangements. Another idea is to develop a new multi-country credit mechanism. This could enable the IMF to deliver short-term liquidity quickly and simultaneously to several countries with strong underlying fundamentals and policies. The unique feature of this idea is to unilaterally offer assistance without an actual request for support by countries concerned. The new mechanism would aim to strengthen confidence and stem contagion from systemic shocks, either global or regional, by proactively offering financial support to countries that could be affected and hence could act as transmission channels. By unilaterally offering assistance to a set of qualifying countries, this could reduce the so-called stigma and address first mover problems. Another option could be to strengthen the surveillance of capital flows, possibly within a multilateral framework. Well, surveillance might not be a good word, and I should say strengthen the monitoring of capital flow. I think that will be a more appropriate word. By gathering more information on cross-border flows and exposures, we could enhance our understanding of both the volatility and capital flows, as well as the measures to better manage these flows, which could help reduce the need for self-insurance. Another example, strengthening the peer review mechanism, particularly to focus on the policy adjustments countries need to implement for the system to operate effectively, could also help. One of the examples of strengthening the peer review mechanism is the G20 mutual assessment process. This G20 MAP exercise is a major step in this direction, and the IMF is supporting this G20 process with its analysis of global developments and policies. As part of the understandings on policy adjustments, a multilateral dialogue could consider limiting foreign exchange market intervention and encouraging a more flexible exchange rate regimes. That is another idea that we might be able to pursue. So these are the options on the demand side. On the supply side, greater diversification of reserve assets would reduce exposure for the system and individual countries as well to risks stemming from any single country. While a multipolar reserve system may not enjoy the benefits of broad use of a single reserve asset, the presence of alternatives provides a safety valve from unsound policies of any single reserve issuer. A more multipolar system may develop over time, but in the near term there is no clear contenders to match the depth and liquidity of the US dollar markets. The more widespread use of alternative reserve assets will happen only if countries see benefits from this. And with any transition to a more diversified system, reserve holders would need to adjust their portfolios gradually. Mechanisms for collaboration would also be essential to bolstering the stability of the adjustment process. Another option could be to seek a greater role for the IMF currency, that is, special drawing rights. As a basket, the SDR diversifies the currency and interest rate risks of its constituent parts. Thus, it has a more stable store of value and unit of account attributes. Moving to a more SDR-based system, however, would require increased supply, greater liquidity, and transparent automatic rules for determining the currency composition of the SDR basket. Again, this is not something that will happen in the near term. Now, so anyway, these issues are related to the reform of the international monetary system, especially the issues related to the revision of the lending facilities of the IMF is under discussion at the executive board of the IMF with the aim of reaching some kind of conclusion by the annual meeting this autumn. Now let me conclude with a few thoughts. The range and magnitude of the policy challenges we face for countries, for regions, and for the system as a whole are indicative of the depth and lingering effects of the global financial crisis. With that, there is an enormous opportunity, an opportunity to secure a strong and more inclusive global financial order, and in turn sustain global growth and financial stability. To do so, international cooperation will be more important than ever before. Asia is a leading force in reshaping the global economy. Asia's voice through its economic success and policy leadership is louder than ever before. And Asia can and should continue to lead by example. Its economic strength is a lesson in itself, the dividend of effective policies, ensuring reforms and growing regional cooperation. Regional cooperation and policy dialogue is thriving in Asia. The regional financial mechanism already plays an important role in the provision of global financial insurance. The growth of regional economic monitoring and analysis, such as through the ASEAN Plus 3 Regional Monitoring Office, to be based here in Singapore, is another example. Importantly, the global governance structures are evolving to better reflect today's global realities. Asia can contribute to the reform process through strong representation of major standard-setting bodies, such as the Financial Stability Board and the Basel Committee. There is also a need to carry out IMF governance reforms, including realigning IMF quota shares to reflect the increased economic weight of emerging economies in the global economy. This will be another key step forward. This is another key step toward more legitimate and more effective representation. Today's event and others in the months ahead are an opportunity for us to exchange views with our colleagues in Asia. I am especially excited to be returning to the region in July for the high-level international conference co-hosted by the government of Korea and the IMF. Given the enormity of the challenges facing the global economy, the conference in Korea, for example, will offer a great opportunity to share Asia's successes and vision in managing these challenges. The world needs strong Asia, and Asia needs a strong world. Thank you very much.
Thank you very much for a very timely and comprehensive lecture. We've covered the Asian recovery, the risks, the challenges in policy normalization, and Mr. Shinohara has also spoken about the international monetary reform agenda and the work underway to try and create an international financial safety net, the work on IMF governance, and the role of regional integration and the linkages between the regional and the global bodies. I guess in the short term, we have to believe in life after debt, and we're going to get through these European debt problems. But let me just begin with one general question. You've alluded to the global rebalancing, and I'm wondering how you see Asia's contribution to that rebalancing in terms of the design of its exit strategies. Because on the one hand, it seems to me the world wants Asia to generate domestic demand to offset adjustments elsewhere in the world. On the other hand, there's a need to withdraw this policy stimulus. How does one get that balance in terms of the contribution to the global imbalance reduction and the domestic factors? And is this problem becoming more difficult in light of Europe's problems? Because presumably Europe is now going to be speeding up in terms of fiscal deficit reduction, and someone else somewhere in the world has to, in a sense, take up the slack. Thank you.
Thank you very much, Charles. It's a very difficult challenge before us, and we already know that in order to sustain the global growth from a long term, from a medium to long term viewpoint, we need to have a certain balance of certain rebalancing of the demand from a global perspective. And in the near term, it is clear that the fiscal consolidation efforts in Europe needs to be strengthened. And those efforts will likely to dampen the domestic demand in advanced economies. Of course, credible policy actions that is being taken in Europe can mitigate the short-term impact, but certainly we are not in a position to expect much from Europe or in other advanced economies in this respect. So there is a need for other regions to fill the gap in global demand. And the role of the emerging economies is quite important. There is a great need for emerging economies, especially economies with large external surpluses, to contribute more to the global demand. I guess what we need to do is to enhance, for example, social safety nets, to reform the corporate governance, to develop financial markets, and also there is a need for higher infrastructure spending in emerging economies. So those efforts are needed in order to reduce the high savings and to boost internal demand. In some of the countries, greater flexibility in exchange rate would help support the demand rebalancing in those countries, and I guess it would also help. It would also have the added benefits of helping those countries manage volatile capital flows. So all in all, I guess we are in a very challenging period at this moment. We should not get into the discussion of the burden sharing here. I mean, we have tried to do that in the past, and we didn't succeed very much in our arguments for the burden sharing discussion. So clearly, the rebalancing of demand and the role of the emerging economies in this respect would benefits the emerging economies themselves, and greater collaborations among the economies is quite important in this respect.
Thank you very much. If I could throw open the floor to questions. If you could go to a microphone and give your name and affiliation. Thank you.
I'm Clement from Ministry of National Development. I would like the conference to address the issue on the influx of hot money into Asian property markets. Okay, as we all know, U.S. Federal Reserve currently adopts a low interest rate policy as at 0.2% in recent months. This is even lower than the Greenspan era of 1% during 2002 to 2004. As a result, you can see a lot of dollar carry trades that is occurring in the markets now. I have 4 questions regarding this. First question, is there a need to regulate hot money into Asian property markets? Is this destabilizing the Asian property markets? And second question, in 1984 U.S. presidential election, Democrat candidate Walter Mondale mentioned that rising government debts could lead to rising interest rates. Although Federal Reserve adopts a low interest rate policy now, is there a possibility that interest rates in U.S. will suddenly rise out of nowhere and attract capital capitals back to US. And this is something which I've been thinking about because Federal Reserve has no rationale to raise interest rate now, especially when the economic recovery is just taking place, but the markets may think otherwise. Okay, my third question, right, is regarding China's interest rate policy. I have always been confused when China says that they want to raise interest rate to curb inflation and to slow down economic growth. Because if the economy is fueled by hot money, if you raise interest rate, that will increase the interest rate differential. And this will attract even more hot money into into China's property market and generate even more rising asset prices. Yeah, this is my third question. What will happen when China raises interest rate? The fourth question is, what is your analysis of hot money inflow into Singapore's property market? Thank you very much.
Okay.
In the questions you wish to.
Well, I guess these are the hot issues, I suppose. I guess the inflow of capital itself is something that you should always welcome. It is very difficult to differentiate the volatile capital inflow and stable capital inflow. But in any case, the concept we always need to keep in mind is that capital flows into your country because your economy is performing well. And if your economy is not performing well, capital flows out. So capital inflow itself is a good thing. And but volatility in the capital flows could be disruptive in certain circumstances. So as I said that in my speech, I guess there are a range of tools that are available to many of us in coping with the impacts of the capital inflows. The traditional way to work on that is to use the macroeconomic policies. And if, for example, there is still, I think I shouldn't get into the detail here, but also I talked about the macro-prudential measures, for example, loan-to-value ratios and things like that. I think that is important to maintain the soundness of the financial system as well. Exchange rate flexibility, we believe, is one of the tools that can mitigate the impacts of the capital flows. And as I said already, there are circumstances, exceptional circumstances, where you might want to think about capital controls. But I guess we all need to be very careful in contemplating on this tool because it could have huge impacts on the market perception, and it will create market distortions. I mean, it would have negative impacts on the resource allocation, things like that. But there are exceptional circumstances where the capital flows are very temporary and very volatile, that you might want to use capital controls. Of course, usually it is very difficult to implement effective measures to control the capital flows. So this is one of the tools, clearly one of the options that you might want to contemplate upon, but only in exceptional circumstances, I suppose. The U.S. interest rate, I guess the Federal Reserve has been clear about this on this issue, but the U.S. economic recovery is still tentative. And I guess the U.S. monetary policy will continue to be this way for the time being. The government debt problem in the U.S. is also a challenge to the U.S. government, and I'm sure that the U.S. will work more harder on the government debt problems. You asked about Chinese interest rates and hot money to Singapore. I guess you need to, focusing on just the capital control, focusing just on the capital flow will be a mistake. I think what you have to take a look is the inflationary pressure in the economy, and how the asset price is moving, things like that. And in case of Singapore, I think there was some surge in real estate prices in the past, but thanks to the prudential measures taken by the Singaporean government, I think the inflationary pressure in the real estate area is contained at this moment. We are very happy to hear about that. Is that okay if I stop here?
Thank you very much. If we can go to another question. Please keep your questions very short and sharp. We have limited time down here.
My name is Klaus Borick from DZ Bank, and I have one question, Mr. Shinohara. You were mentioning, I think, Europe, a growth rate in 2011 of 1.5% versus around 1% in 2010. Seeing the current environment in Hungary developing and in other more southern European countries, I would be interested to get to know, to learn about your assumptions of that growth. Thank you very much.
The numbers that we have shown in the slide is as I said, it's the World Economic Outlook that was published in April, and since then, as we all know, there has been certain developments in the market, and we have to admit that there are significant downside risks to the economic outlook. But these are the risks that we are, these are the, how to call it, risks that we need to take into account. The numbers that are coming out, actual numbers, economic numbers that are coming out from the market is still strong, and as expected in the past. So we need to watch the situation very carefully, and take actions as necessary. But as I said at the beginning, we need to admit that there are significant downside risks to the growth in Europe and its potential impacts on other regions of the global economy.
Thanks a lot, Chairman, sir. Well, sir, I have an interlinked question, if you don't mind. Firstly, with regard to your presentation, I think the issue that, the advanced financial sector, I think, reform. Now, you are putting in great emphasis on the question of implementations as a key factor by way of timely, efficient, and consistency, but I think it's too simplification for that. Now, there's no, insight with regard to the question of the way forward, the lead way forward in new thinking, a resolve to solve unthinkable, universal problems, no longer a regional or national problems anymore, because when you talk about globalization, it's not as simple as that. So could you elaborate that, for example, technology and the others, collaboration and so on is so important. So my question really is with regard to, likewise, the EU just introduced the dollar wall 1 trillion euro, very much a dollar factor rather than a firewall, fiscal firewall requirement that the world require. So it's very much a Eurocentric solution to resolve immediate problem. Now, I was looking at your conclusion, very good qualitative factors in terms that, for example, sir, that have the IMF consider the W2Y factor, won, yuan, and yen combination is union, has a possibility to cushion the North Asian dimension in case of future problems. And the three factor would be very important before the others, ASEAN and so on, can be done. For example, as you notice, that the Japan bond sales is going to be a big problem for Japan. So such a situation, how does he foresee the right solution that you think is going to be beside your food for thought, will be our food for thought to consider? Thanks a lot.
I'm not sure I got your question right, but I guess when we think about the international financial system as a whole, we have not still come up with a good solution to the problem. We are talking about the importance of collaboration. We are talking about the importance of regional collaboration, things like that. But I guess it is clear that we don't have any clear solution to the problem at this moment. The dollar will continue to be the single most important currency that will be used globally. And the market doesn't expect other currencies to play a major role in the market. And in that circumstances, of course, we can talk about other options, but and we can talk about those theoretical things. But I think it is fair to assume that the current mechanism, although it contains lots of problems, the current mechanism will continue for the time being. And whatever we think about those issues, so we need to assume that fact. Many people talk about, for example, Asian currency unit, things like that. But I do not think it is something that we can achieve in a foreseeable future. And as you know, Asia is a very diversified region. Even in Europe, we have seen lots of problems. The process of integration is a very, very difficult one. So I guess we need to take it. We need to base our discussions on the reality. We need to face our discussions on what is going on in the market. I think that is all I can say in response to your question.
Additional questions? We have a question here.
Good morning, everyone. My name is Teresa from Megabank, Singapore. My question, just one question. There's a saying in the market that single currency system might be a failure. Do you agree, Mr. Shinohara? If yes, why?
I think single currency probably will be the ideal solution to all of us. Single currency means one global central bank controlling everything. If that is materialized, I guess we will be probably in a much safer world. But there are lots of conditions that need to be satisfied in order to achieve that. As you can see in Europe, they were successful in having one currency in the Eurozone area. But they didn't have enough mechanism to work on the fiscal adjustment area. For example, there are rich countries and poorer countries under the same currency. Then you have to work on how to transfer some type, certain amount of income from the rich area to the poor area. And that is one of the examples. So I guess ideally it is better to have a single currency because it can reduce the exchange rate risks. It can reduce all other problems associated with the discussion that we are having right now. But in order to achieve that, there are lots of obstacles that we need to overcome. And frankly speaking, it is not realistic at this moment.
Thank you. Well, look, let me just conclude with just one question about the international monetary reform. You referred to this international financial safety net, and you suggested the IMF was trying to develop multi-country credit lines, expand the flexible credit line, etc., etc. I'm wondering what kind of size of resources would the IMF need to play that kind of role? And would it come through quotas or would it come through additional borrowing?
What we are discussing right now is an idea of the kind of a multi-country swap line that is quite similar to the swap line extended by the FRB in 2008 to 2009, and it is reintroduced recently. One of the problems we had with the FCL, flexible credit line, was that some of the countries, especially in Asia, didn't want to make a request to the IMF in order to get support, even though it's a precautionary arrangement. They didn't want to, knock the door of the IMF. So idea is for the IMF to knock the door of the countries, to knock the doors of the potential users of the IMF facilities. So it's a kind of a user-friendly idea. Because IMF has certain facilities. IMF's facilities are useful ones. And we do not want it to be wasted because of the negative sentiment toward the IMF. If countries want to use IMF facilities, they should be able to use it without stigma, without any negative feelings about it, without any wrong market perceptions. That is why one of the options we are thinking about is to create this multi-country swap line or multi-country credit arrangement or something like that. Coming to the question that you have raised, our discussion has not reached that level yet. We have not been talking about the size. We have not been talking about where the financing comes from. But our basic idea is that it will come from the IMF's general resources, and if it is not enough, it could come from the multilateral borrowing agreements called NAB, or if that is not enough, we could activate the bilateral borrowing arrangement. So the financing source is not different from other lending instruments. That is our assumption. But in any case, the discussion on these possible new lending instruments of the IMF is still ongoing, and we don't know the outcome of the discussion yet.
More questions?
My name is Cynthia Marr from Moody's. My question is on the assessment of the risk of a hard landing in China, given the importance of Chinese growth to the global recovery. How do you assess the risk of bursting of an asset bubble?
I think you know better than I do on China, I suppose, but as far as I know, the Chinese, the performance of the Chinese economy is pretty good, although there are some degree of inflationary pressure there. But all in all, I guess the Chinese economy is still in a sustainable path. Of course, and one thing that I want to add here is that there is really a rebalancing of the demand within China is ongoing. Of course, whether that rebalancing is enough or not is another question. But the dependence on external demand is becoming smaller and smaller gradually. I do not detect any sharp decline of the Chinese growth at this moment. We are expecting Chinese economy to continue to grow for the time being. The growth rate may vary over time, but I guess all in all, the performance is something that we don't need to worry about.
One final question here.
Good morning, Emma Ryan from MAS. I was just wondering what your thoughts were on the European response to the crisis so far. So on the European Stabilisation Mechanism and the ECB bond purchases. Do you think they'll be successful? And if not, what other options are left for Europe? Thank you.
Well, I don't know how to respond to that. I think the only response is yes. That is the response to your question. Of course, the situation is not easy. It's a difficult period for the European economies. But they are making their own best efforts to cope with the situation. The Greek program that we have agreed upon, the IMF has agreed upon with the government of Greece together with our European colleagues, is a good one. The program tries to deal with the immediate liquidity problem, as well as the structural reforms necessary to improve the productivity and competitiveness of the Greek economy. The European community has introduced European stabilization mechanism last month. That is the precautionary arrangement in case something happens in other periphery European countries. And I think the special purpose vehicle, in order to carry out that arrangement, the specifics of that has been agreed upon by the Euro finance ministers. The ECB is working, is trying to play its role by purchasing government bonds in secondary markets. The central banks have introduced US dollar swap lines in order to prepare for, in order to mitigate the liquidity problems. Many countries in the European economies have renewed their efforts for fiscal consolidation. As I said in my speech, how do we achieve the growth? How do we achieve how do we restore the competitiveness of some of the European economies? is also very important. It is easy to say, but it takes time, I guess. But I'm sure that there is a very strong will within the European community to achieve all those purposes. So we are pretty much confident about how it goes from here.
Thank you very much for an extremely interesting and comprehensive presentation. I've been asked to tell people that Mr. Shinohara's speech and the slides are available on the IMF website. The address is www.imf.org. If you Google IMF, you may end up with the International Metal Workers Federation. Stay away, go to IMF, and the slides and the speech will be there. But look, thank you very much for an extremely interesting presentation.